Hello, and you're welcome to Global Business Insights, where we go deeper into the main global business stories. First, in the US, where we saw jobs added in May, that's the non-farm payrolls, 272,000 jobs, much higher than forecast, and as such, pushing back market expectations for the timing of Federal Reserve rate cuts. The data was out of sync with some of the recent weak economic activity data we had seen earlier. The Bundesbank has reduced growth forecasts for the German economy to 0.3% for this year and 1.1% next year, but slightly raised its 2026 forecast to 1.4%. The forecast for German inflation was also raised this year to 2.8%. In a move that was widely expected, the Reserve Bank of India's Monetary Policy Committee kept the repo rate at 6.5%. They also raised India's GDP growth projection for this fiscal year to 7.2% from 7%. Governor Shaktikanta Das said the RBI wants to see a fall in inflation, pointing to persisting food inflation pressures, with vegetable prices rising by double digits. The U.S. National Highway Traffic Safety Administration said today that Kia America is recalling 462,869 Telluride vehicles in the US due to a fire risk from overheating front power seat motor. And oil futures got a boost as prices seem to be stabilizing after falling most of the week, after Saudi Arabia's energy minister restated that an OPEC Plus plan to unwind 2.2 million barrels a day in voluntary cuts later this year can be paused or reversed. Non-farm payrolls NFP in the US was up 272,000 in May, a huge beat, closing the door to a July rate cut after a revised 165,000 increase that was revised from 174,000 in April and coming in above the market expectation of 185,000 jobs. Monthly average hourly earnings was higher than expected at 0.4% compared to 0.3% expected, and double last month, that's April, 0.2% a month. Delay in rate cuts means higher costs for dollar borrowers like many emerging market economies. A data-dependent Fed, even though they are not expected to cut rates in June or maybe even July, could signal a more hawkish tone at meetings, leaving the options open for September cut. Looking at some of the details, employment was led by healthcare, adding 68,000 jobs in May. Government employment added 43,000, while leisure and hospitality added 42,000. Employment in food services and drinking places added 25,000, with little or no change in other major industries like mining, oil and gas, extraction, construction, manufacturing, wholesale trade, transportation, financial activities, and others. Looking at other details, the unemployment rate rose for all racial groups except for white Americans in May. The uptick, if you look at jobless rates, the uptick in unemployment was more pronounced for black men and women. Black men actually saw their unemployment rate jump 6.4% from 5.2%. But let's look at some of the other data that came in earlier in the week that could affect the interpretation of the data, the non-farm payrolls we just got. US April job openings and labor turnover survey, that's JOLTS, with vacancies we saw falling. It stood at 8.059 million, that's openings, below the downwardly revised 8.35 million posted in March. The automatic data processing, that's ADP, chief economist Nella Richardson said they were also monitoring pockets of weakness tied to both producers and consumers. The ADP private sector and more limited survey showed 152,000 new positions created in May, below forecast of 173,000, with annual pay also up 5%. Then we saw initial jobless claims. That was up by 229,000 in the week ending May 31, worse than 220,000 anticipated, also above the previous weekly increase of 221,000. The data coming out today may debunk the narrative that the job market is hurting as the impact of high rates weigh on economic activity, but we could still get future revisions. The latest personal consumption expenditure PCE index report, which is the Fed's preferred inflation gauge, was steady at 2.7% year on year in April, with the monthly PCE up 0.3% as forecasted, while the core PCE was slightly lower than expected. But wage earnings growth at 0.4% from the NFP data, doubling 0.2% last month, presents a more up-to-date situation than the April PCE and may be predictive of higher May PCE at the next read. The Fed said at the last meeting that they see risks to achieving their employment and inflation goals moving towards better balance, and they also saw an improved median unemployment rate of 4.0%. That's the March forecast compared to 4.1% in December summary of economic projections. The conclusion at the May 1 meeting was that the labor market remained strong. They may be more cautious in their choice of words on the strength of labor market at the next FOMC meeting. On reaction of markets, US stocks futures sank into the red, while US Treasuries yield and the dollar index spiking up, reflecting a higher chance of rates up for longer. When markets opened, we also saw US stocks in the red, but we've seen since a recovery. That's as we speak. Equities are mostly positive. Dow, Nasdaq, and the S&P are all back in positive territory. Russell 2000 is still down in negative territory. Has the Fed boxed itself in its data-dependent mindset, or are they right to hold on for a while till they get more confidence from the numbers? In short, you can find the data to tell the story you want to see, and the Fed will need to be much more discerning. But there are other data prints that will help clarify the position for the Fed. Next Wednesday, we get latest May CPI, which might brighten up the mood. But for now, it seems the hawks have won the day. The European Central Bank cut its benchmark rates yesterday. Here's a replay of comments on that decision by senior market analyst Lukman Otunuga.
As widely expected, the European Central Bank has cut interest rates by 25 basis points in June, marking its first rate cut since 2019. To make things clear, the ECB's Governing Council has cut the refinancing, deposit and marginal funding rates by 25 basis points to 4.25%, 3.75% and 4.50% respectively, marking its first cut since March 2016 for refinancing and marginal funding rates, and since September 2019 for the deposit rate. The central bank stated that it will follow a data-dependent approach, and it is not pre-committing to a particular rate path. Interestingly, the inflation projections for 2025 was raised to 2.2% from 2%. During the press conference, ECB President Christine Lagarde adopted an upbeat tone on the European economy recovery, but also highlighted economic risk remain tilted to the downside in the medium term. The euro initially jumped over 30 pips in investors' mode over when next the ECB will cut interest rates in 2024. Traders are currently pricing in a 95% probability of another 25 basis point ECB cut, not in July, but in September. Now, the biggest takeaway from this event is the European Central Bank officials are all but excluding a second interest rate cut in July. And some will still question if such a move would be wise at the following meeting in September, according to people familiar with the matter. Another thing is the discussion on Thursday barely considered the possibility of a reduction next month, and there's currently no settled consensus on decreasing at the subsequent gathering on September 12th, where they issue the next round of quarterly forecasts. Ultimately, following the European Central Bank meeting, markets gave a tepid response as this was widely expected. Speaking of monetary policy, first it was the Swiss National Bank, then it was Sweden's Riksbank, now it's the Bank of Canada cutting interest rates. In the G7 space, it is the first to cut interest rates by 25 basis points, as widely expected by markets and economists in a Bloomberg survey. This will be the central bank's first rate cut since 2020. Now, the Bank of Canada cut interest rates as it sees a soft landing on the horizon, with officials more confident that inflation is headed to the 2% target. With further and more sustained evidence underlying inflation is easing, monetary policy no longer needs to be as restrictive. This was words said by the Bank of Canada head, McClam, in the opening statement. Now, although officials have flagged global tensions, a faster than expected rise in home prices, and high wage growth relative to productivity as potential risks to the outlook, it looks like more rate cuts for the Bank of Canada are on the horizon. Traders are now pricing a 62% probability of another 25 basis point rate cut by July, with a move fully priced in by September. This week, we've seen the Canadian dollar weaken against the most G10 currencies based on the decision. Looking at the dollar versus the Canadian dollar, it could trade lower based on a possible policy divergence between the Federal Reserve and the Bank of Canada.
And looking at oil prices this week, as ECB cut rates, there was some optimism on economic growth that helped demand projections for oil. High cost of borrowing slows economic activity and can dampen demand. Oil prices were also supported by OPEC Plus members Saudi Arabia and Russia, indicating readiness to pause or reverse oil output increases if that was required. The interest rate cut of the European Central Bank, apart from providing a macro upside to prices, also raised to some extent hopes for a potential Federal Reserve interest rate cut in September. But crude oil is still headed for its third straight weekly loss on demand concerns after slipping earlier this week on last Sunday's decision by OPEC Plus to phase out some oil output cuts from October, and also on rising US inventories. As we speak, Brent crude is attempting a recovery, but still just under $80 a barrel. The strong latest US job report, which was bearish initially for risk assets, may also have hurt sentiment for Brent crude prices. European stocks were mostly lower as investors digested fresh US jobs data and the European Central Bank's latest interest rate commentary. In the US, stocks were mixed after dipping initially into red following release of the Nonfarm payrolls data showing a strong labor market. Looking at African stocks, the all share index, that's Nigerian Stock Exchange, closed up 0.09%, while the South African all share index, as Johannesburg Stock Exchange, closed down 0.35%. Looking at European stocks, mostly lower, FTSE 100 down 0.48%, German DAX down 0.51%, and CAC 40 also down, that's the French index, down 0.48%. And in the US, as we speak, the Nasdaq is positive, up 0.14%. Dow 30 up 0.16%, S&P 500 up 0.22%, while Russell 2000, that's the small caps index, is down 0.78%. Well, that's it from me on Global Business Insights. This is Podi Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Thank you very much for watching. Enjoy the weekend. Bye-bye.